Good evening, everyone. We are ready to start now. We can start looking at today's topic, and maybe just as a recap for the people who are joining us for the first time, we started this journey by just looking at personal financial planning. So the first day, what we went through was the personal financial planning process. And through that process, we came up with about 6 steps in terms of what one needs to do. And that starts with the determining of your current position, then developing the financial goal. And in financial goal setting, we came up with a couple of steps whereby you have to look at what is that you want to attain in the short term, in the medium term, and the long term. Then once you do that, you have to look at what you have and start with that. Come up with an action plan in what you want to achieve. Then allocate the resources accordingly. Then the final thing was to execute and to keep looking at what you need to do. Remember, things change, and so since things change, then you have to keep looking at your personal financial plan and just make sure that you allocate it accordingly. Then we looked at the factors that determine your personal financial planning goals and what you can do. These among included your age, the liquidity that you have, the knowledge that you have, the level of income, and also your specific taxation matters. Then last week, we went through some of the key pillars that you need to take into account as you are going through your personal financial planning. We went through the budgeting process. We looked at how savings, and we said that savings is a necessary expenditure. Just like you treat your rent, then you should treat your savings. Then we went through debt management and why we should not get into just debt for the sake of getting into debt. Then we went into investments, and that's where we stopped. And last week, in terms of investments, we looked at pooled funds. What are the funds that you can invest in, and depending on your risk appetite. So we went through the money market fund, equity fund, balanced fund, and say depending on your investment horizon, what can you invest in, and do a couple of questions on the money market funds. So today, I want us to go through the investment in the stock market, and in that, about investing in the stock market, I will just take a step back and look at the securities market and just look at what are the kind of assets, the asset classes that you can invest in, and the key subdivision. They are divided into two sort of investments. That is the traditional investment, the alternative investment. In the traditional investment, we have equities or the stocks. That's what we shall be covering today. Next week, we shall go through the fixed income and how to make decisions on fixed income investments. Then we shall do alternative investments. We shall start with real estate and then private equity market later. So just to give us as a recap from last week, looking at the various assets and where they fall in terms of the potential return, risk, and liquidity. The stocks, we said that the potential return is high. The risk profile is medium to high because they are relatively volatile. And today we shall see where they fit in the portfolio. And then the liquidity, we said it's kind of medium because you just need, after you sell your shares, you need 2 to 3, you actually need 3 days for them to settle, and you can have access to the capital. So we shall look at the cost of trading and things like that, and how you can make a decision in terms of what stock to buy. So to start, as a starting point is to what is really a stock? What is an equity? A stock is a unit of ownership in a company of a listed exchange. So it's really the piece of ownership in a company. So that is what basically the stock is. It's who owns the company. So currently in the Nairobi Securities Exchange, we have about 63 companies that are listed there. And for you to trade, you have to open a CDS account. And with the CDS account, then you can go to a broker or an investment bank, and then you're able to buy the stocks. So if you don't have a CDS account, then it's a simple process. First of all, you decide which broker you want to use or which investment bank you want to work with. Then you go open a CDS account. There are a couple of requirements, maybe your ID number, your PIN number, and all that is required. Then in terms of what the minimum amount of shares that you need to buy is about 100 shares for any stock. So that is the basics of investment. So things to be aware of while investing. So yes, investing is good, but just remember that stocks really react to the ongoing economic news. So for example, and we shall see it much later, during times of noise, so for example, during the political the political crisis that we had you could actually see the stock market reacting almost directly and coming down. If you think about the financial crisis, again, you'll see that coming down. So it's really volatile, and it's actually driven by how best the economy is doing. So currently in the Nairobi Securities Exchange, the performance of the market is largely driven by the institutional clients. By institutional clients, it's things like the pension schemes, the SACCOs, and things like that. Then the foreign investors play a big part in the performance of the market. Currently, 60 to 70% of all trades actually happen in the foreign market. So what is happening in the international markets actually determines much more what is going to happen in the Nairobi Securities Exchange. So as you're buying stocks, there are some of the things that determines what stocks to buy, or things that determine the performance of the stock include the free float. Free float is really just the number of shares, the percentage ownership that is actually tradable. So for example, if today we said we are listing, let's say for example, XYZ company, we are listing, we are the founders. As it is, we cannot list all the stocks. So maybe we list about 60-70% of those shares. The 30% that is easily tradable is what is called free float. The more shares that are in free float, the easier it is for you to trade. Then liquidity is the number of shares that are available for trading. So it goes in line with the free float, but you could have a lower free float, but at the same time, the number of shares available to trade are more. So like Safaricom has a lot of liquidity because there are very many number of shares that can be tradable. Then market capitalization. This is the value of the stock, the value of the value. It's really just taking the number of shares issued times the price, and then you get the value of the shares that are tradable in the market. The companies that have a big capitalization actually are really much easy to trade, and they also determine much in terms of who gets in. So for example, if you think about an institutional client, they will not buy into stocks that do not have huge market capitalization because they are not able to buy as much as they would need. Then you have the potential upside. By potential upside is you can actually look at, if the stock is trading at 10 shillings today, you might think that it is going to get to 15 shillings. So the potential upside then is between 10 and 15 shillings. So if the companies with higher potential upside, they're the companies that investors would seek to buy. Then the dividend yield, or the dividend that is expected to be paid by a company, also determines the stock that you need to buy. So when you go to the market today, you'll actually realize that a company like Barclays will always give more dividends compared to a more growth company. So these are some of the factors that you need to look at when you're determining what stock to buy. Then I just thought it's good for us to go through who are the key players in the stock market. Then the key players really include the Capital Markets Authority. This is the regulator. We have the Nairobi Securities Exchange. This is the company that actually provides the platform that is used for trading, and it's also listed on the Nairobi Securities Exchange itself. The CDSC Corporation. This is the state corporation that provides the safekeeping of the shares. So once you open an CDS account, they're the ones who keep safe who actually are the custodians of the shares. Then you have the stockbroker. These are the companies that provide the actual trading of the shares. Then you have the fund managers. The fund managers are professional money managers who actually invest on behalf of clients. So there are about 24 licensed fund managers in the country at the moment, but not all of them actually offer retail transactions. Then the question is, remember, there is nothing for free. So what are some of the costs that are involved when you're investing in the stock market? I just thought that is important because it actually eats into your return. So the total fees for buying and selling shares at the moment is about 2.14%. So if you're investing today at 10,000 shillings, you'll only have about a net of about 9,700 shillings to invest, because the bulk of about 2% of that goes to trading. So assuming that you are getting in and out of a stock, you are buying the shares at cost of 2.14%. Then the day you'll be selling, remember also you have to pay the broker, all these other fees again. So that is on average, the amount that you need to get in and get out of a stock is about 4%, which is double this amount. So we have actually now looked at how to invest, who to speak to, who are the key players. So the question is, how do I determine which stock to invest in? So there are a couple of ways that one decides, how do I get into a stock? So some of us would look at the stocks that are trading less than 10 shillings, we call them penny stocks, and say, since I want many shares, then I'll just go and buy the penny stocks. So it not necessarily maybe any analysis, just to look at which stock is trading at maybe 5 shillings and I buy that. Then you can also decide that by products that you consume. So for example, maybe most of us buy Safaricom because we know that we see Safaricom everywhere. So that might convince us in terms of investing. Then the hot tip, maybe just someone telling you that this is going to happen. So why don't you just buy that? Your gut feel, maybe you just feel like then the financial services sector will do well, so why can't I just take a piece of that? The hard mentality, everybody is investing in the KenGen IPO, so why can't I just invest in that? Then some of us actually are a bit sophisticated and go to speak to a broker or an advisor for them to tell us what is it that I need to invest in. Then the other one is just maybe any IPO that comes in, just looking from past performance. Maybe the performance of the IPO has been good, so you just go and buy that. But today I want us to look at the key way in which you should invest in, which is research. Remember, everything that you should do, it should be based on research. So in terms of research, there are 3 key ways in which you can decide how to pick your stocks. One of them is fundamental analysis, or technical analysis, or relative valuation. And we shall go through each of this one. So fundamental analysis, the key question is a good company equivalent to a good stock? You could have a very good company, but it's not necessarily a very good stock because it's fully valued. So if you look at the valuation from today, what an analyst will do is look at the cash flow all the way to the next 5 years, and also and then bring that and use that to value a stock. You might find that a company is really good, the revenues are really good, but they have all been priced in. They have all been priced in the current price. It's already priced in. So for example, Safaricom today is trading at maybe 28 shillings or 30 shillings. Maybe it's the fair value. So it may not be necessarily be a good stock, but it's a really good company. So the fundamental analysis really, in a nutshell, what it involves is you look at the revenues today, you look at the expenses of that companies today, and then you use that to value the company. So you just use the present value, and maybe at some point you shall look at the time value of money as one of the topics that we shall go through, so that we are able to understand when we say you're valuing and bringing and using the discount factor, what are you really actually saying? So once you bring in the valuation of money today, what is the value? So it's always under the premise that money today or money at hand today is better than money that will come much later. So fundamental analysis is basically bringing all the cash flows and valuing it today and say this is what I'm able to pay for this business as at today. But kindly note that not two analysts can actually come with the same valuation when you're using a fundamental analysis. Our assumptions will always give us a different valuation, so it also depends with how sophisticated the analyst you're dealing with is, and also how much they understand the company. So you'll actually realize that some people are really good in a certain sector in terms of valuing compared to certain sectors. So all these are very subjective things that an investor needs to look at as they're making up their decision. So fundamental analysis actually assumes that investors are rational. So no one will buy shares or buy any stock more expensive than it's supposed to be. So that is basically the basis of fundamental analysis. But then the question comes, then why are shares volatile? So some of the reasons why the shares would be volatile is that many people do not look at the actual analysis. They do not look at the investment as a sum total of future cash flows. So they just look at it as a trading vehicle where I'll jump in today and jump in out tomorrow. So those are one of the reasons. Then the greater fool theory. So someone would look at it and say, if this stock has returned 10%, it will definitely return another 5%. So you'll always get someone who is buying on the other side, and we call it the greater fool theory. Then some of them also do, you see, fundamental analysis is really long time. You have to say, I'm buying into this stock today. We have looked at the valuation or the trading cost. So fundamental analysis assumes that you are actually taking in a long-term strategy. And a long-term strategy is anything between 3 to 5 years. So if you're buying into the companies, you should not look, fundamental analysis actually says that you should actually be able to look at this on a long-term basis. So what is involved in fundamental analysis might some of the things are like qualitative things, like meeting the management, asking them questions, and then distilling that into a number, looking at what is happening with the competition, and globally what is really happening in a particular sector. So for example, today when you think about it, if you are to be investing, maybe the right stocks to be investing in is technology, because everything seems to be going on the technology aspect. So if you look at what is happening from a technological perspective, then you might be biased towards investing in technology biased companies as opposed to more archaic sort of investments. So even if you're looking at a sector like maybe banking, which companies are more techie savvy? So those are some of the things that you need to look at. Then when you look at the quantitative analysis now, which includes now actually the number crunching, project the 5-year cash flows, look at the revenues, look at the expenses, look at things like expense ratios, then look at the risk-adjusted discount rate, and a risk-adjusted discount rate is really just the government bond for a 5 to 10 year bond, and that is what you use as a default free rate. We assume that the government should not default. And then you bring that to the present value, and that gives you the valuation of the company that you should actually be looking at. So in a nutshell, you just need to do the projection of a profit and loss account, and then you bring the cash flow and use a discount factor for you to get the valuation of a company. Maybe one day we shall cover and just do an actual example in terms of how do we do the valuation. Then the other technique is technical analysis. Technical analysis just involves looking at the trend analysis of the stock market and also of a stock, and see how it has what has happened over a period of time. So for example, again, I'll use Safaricom. If for example, Safaricom the price of Safaricom has come down to a price like up to 25 shillings or even lower, we believe that it will always touch the highest point that it has been. I think the highest price has been 35 shillings. So if it comes down to a price like 25, then it may provide a buying, it might prompt us to buy. So in that situation, then we would see many people coming in and buying. So that is just technically just looking at trend analysis and making a buy or sell decision. So this would involve also the two main things is just looking at top-down approach and bottom-up approach, looking at the company itself and deciding how you expect it to do, or also looking at the macroeconomic environment and then deciding what is going to happen. If you decide if you are able to actually say this is what is going to happen, then you can actually be able to buy into the stock market. So stock analysis, technical analysis might really just involve looking at just really trend analysis and making a decision. The final methodology is relative valuation. And relative valuation is very simple. It's just looking at the stocks and saying, if for example, KCB is trading at price Y, then Equity Bank should trade at X. So that you're just looking at the price today of Equity Bank and the price today of KCB, and then just saying on average why should they be buying. But it's not as simple as just looking at the price or taking at the price list and looking at that. There are things that you need to calculate, things like the price to earnings ratio. This is just taking the price divided the earnings per share of maybe KCB and the same of Equity Bank, and saying, so which one is cheap, which one is expensive, and then which one should I be buying? So relative valuation is really just looking at relative valuation for this company today and of peers, and also looking at the same companies over a period of time. So these are some of the things that you look at when you're looking at relative valuation. There are quite a number of them, but I just thought to just take two: the price to earnings ratio, the price to book ratio, especially if you are looking at banking stocks, and then the dividend yield today if you're a dividend player. If you are investing for cash flow purposes, then dividend yield becomes quite interesting thing to look at. Most of these matrices are actually found in the newspapers. If you look at the Business Daily, they will have most of these figures for the last financial years or when the company last released their results. So I just wanted us to go through just to see what happens in the stock market. It's really a roller coaster. So I just decided to take the NSE 20 share index and just see what has happened to it from 2001 to where we are. So you can actually see significant dips and significant increases in the NSE share. So, and you remember what happened just before the 2002 elections, the market was coming down, the economy was not doing very well. So, but immediately after the elections, you can actually see an uptick of the 20 share index, so the performance was good, and that was and you are on an upward trend, other than little profit takings here and there. But you can actually see we did very well all the way to about 2007. Then the post-election crisis happened, so then the stock market was significantly impacted. Then stabilized at the same level, nothing really taking direction. Then when the financial crisis happened, then there was a significant dip. Remember, I said that the international investors are actually significant players in the market. So we saw a significant decline. Then after a decline, then there was recovery. And then I remember there's a time the inflation went all the way to about 21%. Interest rates went up. That is 2011, 2012. Then you can actually see the stock market again coming down. Then there was recovery. Then during the election, 2017, again, that is the lowest that we have seen. And then just depending on what we are seeing, the market has really been on a downward trend. And now with COVID, the market is even lower. So this is just to tell you that as you're investing in the stock market, you should really take a long-term view, because the markets are volatile and significantly volatile. Then I just decided to also take the NASI performance. The NASI is the all share index. It actually looks at the entire market. The NSE 20 does not look at the entire market. And when you just look at this, also same volatility, but slightly more kind of a bit stable depending on the stocks that are there in the index. On a price to earnings ratio, this is actually supposed to help you determine whether you should be buying or you should be selling. So this combines both the relative valuation and the technical analysis. If you just look at this chart, the markets are trading much below the price to earnings ratio. So what this really tells us is, for investors, they should be jumping in and buying into the stock market, because the average PE is about 11. It's actually at about around 13 times. So we expect that the market should come back and at least trade at average. So for any prudent investor, this is the time to be looking at getting into the stock market. So in conclusion, investing in the stock market is a good way to grow your wealth. However, knowing what stocks to invest in is key. So it's not just an issue of investing, it's just an issue of knowing what are the right stocks to invest in. So, and also it's good to know when to buy and when to sell. So since most of us actually have a full-time day job, the right thing to do is actually to speak to a financial advisor as you are deciding on what stocks to invest in, or even better still is to look at the performance of the fund managers who have equity funds and maybe just buy in there, because you also benefit from economies of scale. So that is the end of my presentation for today. So what I will do is take any questions from the participants and see how best I can answer them. So you can just unmute yourself and ask questions. I'm taking questions. Apologies. I'm just seeing that my connection was not good, but I don't know if there are significant questions. If you have questions that we can answer, you can unmute yourself.
Elizabeth.
Hi, Chrissy. Hi, Liz.
Hi.
I just wanted to find out.
Hello?
Yeah. Can you trade indices in Kenya?
Okay, thanks, Heta. Actually, you cannot be able to trade indices in Kenya right now I think they are coming up with the derivatives, but so far nothing. You can't trade an index.
Hello, Elizabeth.
Thanks.
I have a question. First, thank you for the presentation.
Okay, thank you.
Yes, I expected we'd get more insights on how to choose the stocks. So maybe you can even just share on a personal level, which stocks do you think are the best to buy and why?
Okay. Stocks to buy. Okay. So, who am I speaking? Who was speaking? Sorry.
Cairo.
Kiru. So, Kiru, for me, I would look at the banking stocks at the moment as some of the good stocks to buy, just because if you go back to what I was showing as a PE, if you look at the price to earnings ratio of the banking stock or the price to book of the banking stocks, it's actually below where it has traded in the past. So for me, I've actually looked at maybe the banking stocks, and the banking stocks I would look at things like KCB, Equity Bank, maybe Cooperative. Those are good growth stocks because they are currently trading at a much significant discounts, and their growth is expected to continue. I would not. That is if you're looking for growth. If you're looking for high dividend stocks, I think something like Barclays is one of the best. It's one of the highest paying in terms of dividend. So those are the stocks that you should look out for. If you look at the ones maybe not doing so well, if you think about like Bamburi, they're going to be impacted with what is going on. So might not be the right time to jump into those. So I would look at it in terms of what sectors are going to do well. So banking stocks are going to do well. And I think Safaricom will continue to do well, especially with what is happening at the moment. But I was just trying to avoid just giving exact recommendation. But those are some of the analysis that I would look at. But again, I can take it up offline with you. I don't know if I can take more questions. Any more questions?
Yes, good evening.
Good evening.
Maybe to ask, maybe for Barclays, would you know the minimum amount they require for stocks?
So, in terms of trading, the minimum amount of the number of shares that you should trade is 100. So if the minimum amount of shares that you should trade is 100, so you take 100 times the price. So for example, if it's 10 shillings, and then if it's 10 shillings, then you add up about trading cost of 2.14. So with even as low as 2,000, you can be able to trade. Okay. Just to open an account.
Okay.
Yeah.
Maybe to add on a question, what is the difference between stock and options?
Stocks are just a direct investment into a company, but an option, it's more of a derivative. So what you will actually say is, if X happen, then I'll be able to buy. So for example, an option, then there can be stock option or something. So for example, a stock option, it will be given to the management of a company if they meet a certain target. So for example, if our revenues are about 1 billion, then maybe the top management will be given X number of stocks. So that is an option. So options are more derivatives. They're actually based on something. At the moment, we don't have any option trading in the market. We only have forwards and forward trades and things like that.
Okay, thank you.
And you can type your question. You can send your question via message, by the chat.
Elizabeth.
Yes. Yes, Kiro.
I was asking, maybe you can comment on the penny stocks.
Okay. Penny stocks are stocks that trade below 10 shillings. And for example, I would say something like KQ. The KQ has come from a price of maybe 120, 100 shillings and has been coming down. So someone might look at it and say, I'm just going to buy a stock that is below 10 shillings, or maybe something like Eveready. So it looks cheap, but it's not cheap, because you see the cheapness of a stock is looking at the price versus what you are going to earn from it. So it could look like a penny stock, it could look like a cheap stock, but it's just that it could be very expensive because the revenues you don't expect to even break even. So penny stocks are basically just stocks that are below 10 shillings, but does not mean they are cheap. So the key driver for any decisions in terms of what to invest in should always be the earnings ability of a certain company.
Thank you.
I guess there are no more questions. Long-term view investing is... So on average, when you talk about a long-term, there is a question from Rose Murioki. Long-term view investing is averagely how long? A long-term investing should be anything between 3 to 5 years, because then an economic cycle has changed. So you should actually look at investing in terms of economic cycles. So long-term is 3 to 5 years should be it. So when you're looking at investment, the longest that you should look at, in my view, is 5. And again, when you ask maybe a different investor, they will ask you something different. But I think 5 years is a long time. I guess there's no more questions.
Last question.
Okay.
Can you comment on offshore stocks and platforms where one can be able to purchase offshore stocks?
Okay. So offshore stocks, the process of investing into of determining what stock to invest in, even in the offshore market, would largely be the same process. So there are a couple of questions that comes in when you're talking about offshore stocks. Is it that you want to invest directly into a country or a certain stock market, or do you want to buy into a vehicle? What I have seen done is actually, when you want to invest in the offshore stocks or offshore markets, it's always better to go through a pooled fund. Reason being, you might not have the time or the understanding of the stocks to buy into when you're investing offshore. So my recommendation would always be look at the right providers, and then through those right providers, then you select what do you want to invest in. Do you believe that the emerging markets are going to do well, or do you think like maybe a country like the countries that invest in maybe the developed markets will do well, so that they will have more investment in the US? So there are very specific sort of providers that do that. So the first question is, where do you want to invest and what exposure do you want to invest in? Then who are the right providers to do that? But when you're investing offshore, a different thing comes in. So because you have now to forecast the currency, and that comes in with volatility. So you're not only forecasting the performance of the company you're investing in, but also the currency. So those are the things that you need to look at when you're investing in offshore. Which providers are good? I would really highly recommend that you invest through a pooled fund, and also make sure that you have a very strong view on currency performance. Then there's a question: if you invested your which has done poorly, should you get out of wait out a GKQ? So the question is whether you should, when a company is doing badly or you have invested and you think the company is not doing well, should you just sell and stay out? The answer is it really depends, because if you think that the company is going to do well, so for example, yes, the company has done well, has done badly, and again I'll go back to something like the banking sector. Maybe you invested in something like KCB and the stock market has come down. If the stock market has come down, it does not make sense for you to cash in your losses, because we know that, or at least when you do the projections, you still think that the company is going to do well. If you think the company is going to do well, then the stock will recover. So you should not sell. But when you think about maybe a company like KQ, it's still not very clear how they're going to get out of the financial mess. So if you have invested in a company that is not really clear, it's still murky, then what might make sense is just for you to maybe cut your losses and just hold on to that cash and reinvest it into another company. So it really goes back to the same thing, determining what is the future value of the company and then taking the right investment decision. So it's not a right answer that if stocks are down, just sell. No. But some companies might not be clear how they will make money in the long term.